Okay, good morning. Happy 4th of July, everyone, and welcome to Saxo's weekly market outlook call. And welcome to H2. To begin with the big picture, unfortunately, I only have words of caution here. Nasdaq's H1 loss of almost 30% was the worst in history, and the S&P down 20%, worst since 1970. US 10-year Treasury yields broke the support at 3%, and I think the key test now is at 2.7%, which is likely to come. So for H2, we are guiding for a lot of caution from several fronts. Of course, the Fed is tightening, and the tightening is at its fastest pace since the early 80s. I mean, we've already seen 150 basis points of rate hikes, and another 150 is priced in for the rest of this year. Along with that, we have the quantitative tightening as well. So that's quite massive. We haven't seen that pace since the early 1980s. In the later half of July, we will see earnings season kick in as well, which will, possibly mean a lot of disappointment because analyst estimates are still quite high, and companies are guiding more than 70% of the companies are guiding for negative EPS. So that does mean that there will be a lot of disappointment to come. And for those who think it can't get any worse, actually equity market valuations have only dropped to the same level as they were during the peak of the dot-com bubble. So again, like I said, valuation wise, earnings wise, and because the Fed is tightening, we do see that a lot of disappointment will come. What this means is that bonds have become more interesting. While in H1 we saw a coordinated sell-off in bonds and equities, and investors didn't really have a room to hide. H2 may be different in the sense that where recession fears are rising and inflation concerns are still there, which means that bonds will probably become relevant again in a portfolio. In the macro picture, we do again see that central banks are trying to catch the inflation train from the back, which means they will have to continue to be aggressive. On that note, I must mention that we have the quarterly outlook coming out this week, and we also have a webinar scheduled for that. Maybe you can sign up for that on our website or the platform if you haven't yet. But that will discuss our views for Q3 and actually until the end of the year. The theme of the quarterly outlook is a runaway train, where we argue that inflation is a runaway train and central banks can only try to catch it from the back. Coming back to the macro picture, US data is pointing to a slowdown. Atlanta Fed GDPNow model is actually predicting Q2 contraction of 2.1% now. And that's mainly after the ISM Manufacturing survey last week had a broad-based weakness. This week, key will be the jobs data on Friday. But to keep the perspective right, jobs growth is expected to slow down from levels we've seen earlier this year. But still, that will be a healthy pace. Bloomberg survey expects 275K gains for June. So that should be on your radar, certainly. Elsewhere, we had Japan's Tokyo inflation come out last week for June and still pressing above BOJ's 2% target. So key to watch because Bank of Japan still remains committed to its yield curve control policy. And there's a lot more on that as well in our quarterly outlook, which comes out this week. But for now, key levels to watch for yen will be 134. A break below that could mean a correction down to 131.5. Just one final line on commodities. OPEC production has declined in June by about 120K barrels per day. Remember, they were supposed to increase production, but they are down 120K barrels per day. Further increases have been promised for July and August, but it is again hard to trust OPEC plus production commitments. And gold, we have seen some downward pressure on Friday specifically. It fell below 1800 because of an added risk from India's import taxes on gold. But gold did bounce off the 1780 support. So that will again be key to watch this week. That's it from me. Thank you.
Good morning, everyone. Just to add a little bit to Friday, I mean, even before the ISM report came out, actually the 10-year bond yield have already fallen something like 13 basis points to 87. And right after ISM report came out, much weaker, and especially on the new orders and in the contractionary territory. And then the 10-year bond, you actually at the high, at the most actually dropped something like 23 basis points to 278. So pretty close to the 270, 275 level, Charles we just mentioned. And then it bounced back to close at 288, 287 kind of level. So there may still be a little bit more. I think there still may be more reaction to come as actually after the ISM report, actually much of the decline has actually reversed and then may actually come down again on the yield. And for time being, and as recession fear, as Charles mentioned, and has been increasing in the US. And back to China and this part of the world. And last week, China continued to outperform overall. And in the short-term holiday short-term week, Hang Seng up 0.65%, Hang Seng up 0.5%. And then is in China, is the CSI 300 was up 1.64% for the week, and that's in comparison to the MSCI All Country World Index actually down more than 2%, emerging market down 1.8%. And S&P also down 2.2% for the week. Northbound and southbound flow both are still stay strong. And I think just a quick summary, and of course we have further COVID restriction relaxation, and the inbound traveler quarantine down to 10 days from 21 days, and also MIT actually announced that the itinerary card will no longer show whether a traveler has recently been in a city with COVID-19 cases. So there's some further, and also the cut in funding for regular PCR testing will also help to reduce the measures no government are doing in PCR testing. And so last week we have some rebound industrial profit and sequentially, and also the official manufacturing and non-manufacturing PMI come out of China also strong. So back to expansionary territory, especially in the service sector. The rebound in the service sector was most notable. And then is in the PBOC's report, it relates PBOC in his monetary policy report is basically reiterate support to the real economy. Not much thing new, but one thing bear to note is that it's give more emphasis to inflation. So don't expect a lot of easing from the PBOC. So that's one caution. And then also the PBOC bankers survey came out also saying that loan demand remain actually weakened further in second quarter. And despite all those monetary easing or encouragement to lending for the bank and so on. So the 5,000 enterprises being surveyed, they actually have seeing deteriorated business conditions. So another thing, I think President Xi's visit to Hong Kong, I think probably not so much to add from here. But I wanted to bring your attention to the Qiu magazine. Actually, on the 30th of June, published a speech of President Xi back in January, and to the party's officials. And one thing I think he emphasized that in the new era of development in China, the principal contradiction actually is between people's need for better life versus the imbalance and uncomprehensive kind of development. So actually, he's pointing to that is in the new development paradigm, basically balancing and of the development model actually is a emphasis in Chinese policy. So not necessarily to be keeping up with the 5.5% growth, but actually it's more restructuring the economy is important. And this week we have Caixin PMI services report coming out on July, and Bloomberg consensus is still calling for a below 50 number, mainly because I think this is more about the SMEs, private enterprises, which are more worst hit. But probably, don't be too surprised if there's some a positive surprise coming from here. And then we will also have the aggregate financing data coming out between the 9th of July or the 15th. They have not really finalized the date. And market expecting this with some rebound to aggregate financing to year-on-year growth 10.7% from last last month 10.5, some small improvement, and also bank loan will marginally higher, but to growth to outstanding loan growth probably to 11.1% year on year versus May's 11%. But I mean, as I mentioned earlier, the survey is still showing that loan demand is still pretty weak in the second quarter in China, and so. PMI, CPI and PPI also coming out on Friday. I mean, it's not really the focus for the market at the moment, and maybe the PPI may came down a bit from last month 6.4 to this month around 6%, mainly because of base effect, and also CPI probably required a little bit to 2.5% based both on a low base effect and also some sequential increase in pork price or year-on-year smaller decline in pork price. Pork price accounting for more than 4% in the China CPI. And another thing is Chinese developer Ximao and actually default in the $1 billion bank bond yesterday, and they failed to pay. So that reminds us about the risk in the property sector. There's still quite a lot of property developer maybe quite still face some stress. And so so that's one thing, and also there's a pickup in COVID cases in China after it had been below, it came down double digit for some for earlier last week, but it picked up to over 300 again, and then Anhui and also reported something like 287 cases for Sunday, and Shanghai 3 local cases. So that's bear watching. And then today is there will be the ETF bond through the Hong Kong and Shanghai and Shenzhen Stock Connect, and 53 Shanghai ETF, 30 Shenzhen ETF, and 4 Hong Kong ETF. I mean, so overseas investor can now buy into 53 Shanghai ETF and 30 Shenzhen ETF through the Stock Connect. So to conclude, I think probably is after such a good outperformance for several weeks, and China probably will be facing some headwind or maybe some profit taking, given I think most of the stimulus measure has been rolled out, and then there's more pickup in COVID cases, and also the bad news from Ximao and all remind us about some risk. So I think that's all for me.
Good morning, everyone. Thank you, Redmond. Thank you, Charu. A couple of things from me, 3 things specifically. First, let's start in equities. So equities, we're kicking off the half year. Volatility is expected, an increase in volatility, if you will. More layoffs ahead of earnings season kicking off, and more downturns are expected. So where to hide? We're still advocating that clients remain defensive. And the areas of the market, if you are looking for more upside, remain in those sectors that are able to ride out the storm and increase their cash flows. Hint, hint, some of those might be in energy. The market is in a cliffhanger, though. We think we're set for disappointment. Quarterly earnings estimates have never been so bullish, specifically in 30 years. I'll say that again. Earnings estimates have never been so high for the quarter as they've been now. So 2 decades, right? So year to date, if you look at the equity baskets that we cover, the sectors that are up the most, there's only 2 baskets. The first one is defense, so specifically the defensive sector. So in that includes some names like CrowdStrike, etc., Raytheon, Lockheed Martin, not CrowdStrike, pardon me. The second best performer, the only second in the black, is commodities. At an industry level, what's our thinking? We think that, well, all in all, across most sectors, we'll probably see weaker than expected results come out, and guidance levels for the year ahead are downgraded, which will spook the market and could see us head lower. So that's a huge risk in the market to be aware of. At an industry level, we've seen layoffs increase in the EV market. Don't forget that Tesla and VW have announced layoffs. In travel and tourism, Air France will get an indication of Boeing later this month. In cryptos, we've seen Coinbase cut numbers. Pharma we are expecting some job cuts in pharma. And this week, we'll be looking for clues from other names in the tech space. Specifically, last week on Friday, Facebook parent Meta warned their employees that they need to execute flawlessly in a slower growth environment, saying that employees shouldn't expect an influx of new engineers and new budgets. So reading between the lines, this means we probably are expecting some layoffs. It'd be interesting to see Samsung's results. They report this week. It'll be really interesting to watch, give an indication for what we can expect from Apple. Apple report on July 29. Samsung results this week will probably reveal that revenue is not as shiny as expected, and we'll probably expect the company to announce that income will grind lower for 2022 and 2023. Perhaps Apple, dare I say, might do the same thing. The second thing that we wanted to speak to you about, or that I wanted to speak to you about, is commodities. So commodities, it's a tale of two halves, or it's a mixed bag, I guess, if you will, with some rising to the top and the majority falling lower. So that leaves the Bloomberg Commodity Index falling from its record all-time high. So it's down in the order of over 10%, being crushed by recession fears. So specifically wheat, cotton, copper, iron ore, and actually oil lower. But arguably the one that's shining up the most is coal. And if you do have a look at coal futures, ladies and gentlemen, they are in record territory. And again, this is because the world, specifically the developed world, is increasingly being forced to pivot towards fossil fuels, i.e. Germany and Australia. Moving to the second component of the commodity basket that we want to speak about, and that is Australia is in the midst of another record-breaking winter flood season. This is not all doom and gloom. However, it does mean that the wheat harvest next year might also be quite good. So this is also at a time when crops in America are facing dry conditions. So that is likely to see wheat prices pick up again later this year. Also, side note, when you're thinking about harvesting conditions, you're thinking about wheat, you're thinking about Australian floods, don't forget to think about insurance companies and look for some opportunities there, whether you are a trader or potentially an investor. The last thing I want to talk to you today is expecting banks to be more hawkish, as in expecting them to rise rates more than expected. And we know when banks rise rates more than expected, we see equities fall. So what are we expecting? Do you remember that movie, What to Expect When Expecting? I wish I could say that. But at Saxo, I guess the first big bank that meets this week is on Tuesday, the RBA. So the market is expecting rates to rise by 0.5%. But at Saxo, as we've written before, we're expecting the RBA to be more bullish than that, expecting a 0.75% hike. This won't be the first time that the bank has made a 0.75% hike. In fact, if you were born in the 90s, or if you were born in the 80s, you might recall that the RBA made a hike this big in 1994. All in all, don't forget to remember that we think that inflation forecasts are wrong, not only in the US but also in Australia. 7% year-on-year inflation is too low, and the Australian Federal Treasurer also said this as well. So this means we can expect higher hikes, higher for longer. What to watch with this? The AUD. So the Aussie dollar is testing a key support level. So if the Reserve Bank of Australia is more dovish, as in, let's say, if they don't, for argument's sake, rise by 0.5%, or if they don't rise anywhere near by 0.75%, the AUD could face some selling pressure. and it looks like the next level that it could test is 65 cents. That's pretty much it from us. From the three of us, we wish you a happy and safe week. As always, please don't forget to reach out to your, whatever you want to call them, your Saxo friend, your RM, your GST, your friend at Saxo. Don't forget to reach out to them. Any questions, feedback, or comments, please reach out to them. Also, don't forget to refer to our Saxo equity baskets as a source for inspiration. And you can access those once you're logged in. You just head to inspiration and shares. But have a wonderful week. Sorry, we've gone over time.
Thank you, guys. Good week ahead. Bye-bye.